Chances are you clicked on this video because you already know that investing into rental real estate is one of the best ways to grow your wealth and income for your financial future. And you're wondering about the ways that you could use a HELOC to buy a rental real estate, especially if you're just getting started. So here in this video, I'm going to showcase 2 ways where you could use a HELOC to buy a rental property. The first way of doing it is pretty straightforward, and that is to simply use your home equity to outright purchase another property without another mortgage. So suppose you have a first lien or a second lien position HELOC where you have $200,000 of equity available to draw. Now you can simply take a portion or all of that $200,000 to then outright purchase a rental property up to $200,000. Now, I personally recommend not to max out your home equity line of credit just for precautionary reasons that we just want to give ourselves cushion room and we don't want to necessarily add a risk to our line of credit by maxing it out. What I generally suggest is that as long as you're not exceeding 70% loan to value on your property. Now, of course, by drawing $200,000 from your HELOC to buying this other rental property means that you just now incurred additional balance and debt. But the good news is that you've now acquired an income producing asset, an asset that not only could appreciate in the future, but has this strong potential of creating income for you through rental income. Now, I've met several real estate investors that got pretty creative when it comes to creating income from their rental real estate, such as renting by the room or listing it as a short-term rental on places like Airbnb or VRBO. So there are other ways, apart from the traditional way of simply renting it out to a long-term tenant, to create rental real estate income. Now, you may have noticed that with this particular way, I didn't mention using the HELOC as a down payment to getting another mortgage to buy the rental property. Now, the reason being is that not only a lot of the banks not allowing this to happen, but I simply think it's a huge risk to using a HELOC as a down payment to incur additional institutional debt. Now, institutional debt simply means a debt from a bank or a credit union or a professional company that lends money as a business. So personally, from a risk mitigation standpoint, meaning reducing risk, I'm not a big fan of using a HELOC, a portion of your HELOC, as a down payment to buying rental properties, getting another mortgage in the process. So with the first way of doing it, you're essentially buying a property outright without incurring additional mortgage or lending from an institutional lender. And again, we're simply doing that because many banks simply don't let you do it. And B, we want to mitigate risk by not sandwiching debt on top of each other. And not to mention the least that you now have additional payments on the HELOC and also a payment on the mortgage itself, which could get pretty costly and it might actually turn your property into negative cash flow. So that is method number 1. Method number 2 involves in creative acquisition strategies such as seller financing, more specifically a tactic that I like to call contract for deed. Now, I get that many of you might not be familiar with this concept of seller financing, so let me explain it real quick using my whiteboard. So let's say you went out there and found a piece of rental property and you know that this property is gonna be spectacular, it's going to cash flow really well, and your return on investment is gonna be through the roof. So you identify a deal, and traditionally what you would typically do, or what most people do, is they will go out, okay, here's you, all right, and please don't mind my stick figure first grade drawing here, but most people will go to a professional lender like a bank, okay, i.e. a bank, to get a mortgage, and the bank's role in this is they're financing the purchase. You may have to put some down payment, but the seller is pretty much getting the lump sum cash up front because the bank is the one that's funding the deal. Now you just have this arrangement between you and the bank where you make periodic monthly payments to the bank to satisfy the loan requirements. So here you are as the buyer, and here is the seller. So pretty typical, right? This is how it may have worked even to buy your own residence. And this is how a lot of people would buy a rental property. However, with a creative financing strategy like seller financing or contract for deed, here's where it's gonna be a little bit different. Now with seller financing, the bank is no longer in the picture. You're not going to the bank to borrow money to fund this deal. Instead, you and the seller will come to an arrangement whereby you're making monthly payments directly to the seller, okay, monthly payments. In exchange, the seller is going to give you then ownership right to this property. Now, when you make those monthly payments, it works just like the bank. In fact, the seller in this case is basically becoming the bank. And with this arrangement, because the seller is giving you the ownership right of this property, you pretty much get to do whatever you want with it, which in this case, we're gonna rent it out to a tenant, or perhaps we turn it into an Airbnb scenario and create profit and income. Now, obviously, the rental income, okay, I'm gonna put the rental income here, the rental income that this property generates has to exceed that of the amount that you're owed to the seller. So if your monthly payment, let's say, is $800 a month, and that's the principal and interest payment that you're making to the seller, just like a bank, obviously we want our rental property rent to be probably somewhere around $1,600 a month, at least double that of what we're paying to the seller, because we also have other expenses like insurance, property taxes. There's also maintenance that we have to take care of, maybe even management costs if you choose to work with a management company. So we have to factor those expenses in and have a separate video about how to analyze a rental property and all its associated costs. So in this hypothetical scenario, let's say $1,600 is our rental income that we generate from this deal, but we owe the seller $800 a month every single month. Yeah, it could definitely work for sure. And going back to the terms of the deal, let's say this property, the asking price or the purchase price was $150,000 and the seller was asking for 10% down, which would be $15,000. Now, in this scenario with a seller financing arrangement, I personally feel more okay or feel safer about using a HELOC to fund the down payment necessary for this deal to work. Now, obviously, all the other numbers have to work, meaning not only do I have a seller financing payment, but now I also have a payment on that $15,000 draw that I did for my HELOC to also satisfy that as well. So the numbers definitely have to work out in terms of not only taking care of all of our expenses, but also paying the seller and also making the small payment that we may have for the $15,000 draw that we did on the HELOC. Now, my suggestion is obviously pay off the $15,000 balance as soon as possible on the line of credit. Free that up so that you're freeing up some cash flow. And at that point, your only obligation is the monthly payment to the seller to the extent of the term that you have with the seller. Now, truth be told, while a HELOC was not involved, this is how my brother and I have acquired multiple properties, be it apartments, single family houses, 8 unit, 10 unit, a 32 unit, or excuse me, a 24 unit. So this is how we've acquired many of our rental properties, apartment buildings that we now have today using seller financing strategies, just like what I'm showing you now. Now, one of the questions that I get all the time is, why wouldn't the seller turn this arrangement down in favor of bank financing? Well, to keep it long story short, it has to do with taxes. In many cases, if a seller has owned the property for a long period of time and their property has appreciated over the years, they may owe a substantial amount of capital gains taxes. Now, with the seller financing arrangement like I'm showing you now, there's an opportunity for the seller where they could defer paying those taxes, which means that they don't have to write a big lump sum check to the IRS or to whatever the taxing body agency might be. And that could be a massive benefit or tax savings for the seller by accepting and saying yes to seller financing. In fact, if you want to learn more about this concept of seller financing contract for deed, we have an entire course that we're giving you for absolutely free. No, it's not a trial. You don't have to give us your credit card number. It's a free course that we're giving away just about seller financing, how to look for those properties, etc. So if you want to sign up for the free owner financing course, I'll leave that in the video description down below, and the link is simply freeownerfinancingcourse.com. I'll leave that link in the video description where you can sign up for free and get some free training about seller financing. So those are two major ways that I've been teaching our students on how to use a HELOC, where you could buy rental properties using the equity that you currently have as a resource to build more wealth, to build income, where you could use that resource to build potential wealth and income for your financial future. So if you thought this video was valuable and helpful, leave your questions and comments down below, share this with your friends, and be sure to subscribe for more videos like this. We'll see you in the next video.